Now we're going to talk about the surge in housing prices, not only here in South Korea, but it's a trend we are seeing around the world. I'm glad to say we have joining us on the phone Kyung-min of the Korea Times. Kyung-min, what do you have for us today?
So house prices tend to fall as a wider economic downturn looms. But this year, property valuations have kept on rising in many countries despite the deep global recession caused by the coronavirus pandemic. This year, house price growth has accelerated to an annual pace of almost 4% among the OECD club of rich countries, with even faster rises in Europe and the US. In the US, falling mortgage rates and higher state benefits shielded the housing market from the pandemic as prices rose by an annual rate of almost 5% in the second quarter. There were even sharper price rises in much of Europe, notably Germany, the Netherlands, Portugal, and Poland.
And what can we say is the driving force behind this price surge we're seeing?
Well, the surge in price is fueled by the vast stimulus packages from governments and central banks put in place to support struggling companies. The measures largely allowed many workers to keep working and earning, while it also kept borrowing costs near record lows. For example, in Germany's case, some banks are offering to lend on 100% of the purchase price. This, together with 10-year mortgages at rates as low as 0.6%, is fueling the property market. Regarding this, Germany's central bank has expressed concerns, saying in a recent report that apartments in the country's biggest cities were 30% overvalued compared with the long-term ratio of prices to rent. However, it added that this reflected rising land prices rather than any, quote, destabilizing speculative demand motives, end quote. The warning came as the volume of land sold each year in larger cities there has fallen by a third since 2012, whereas prices have more than doubled.
So clearly this is a highly worrisome situation. What are the experts saying?
Well, they mostly agree that there are risks ahead, but they also say the influx of capital is attributable to investment funds being reallocated from financial markets to the housing market. Of note is that banks are struggling to rein in their mortgage lending, which is an indication that they are increasingly becoming fretful over risk perceptions related to the general economic outlook. What they mean is that a lack of appetite for lending or tighter credit standards due to worries about borrowers' creditworthiness may challenge the degree to which the monetary easing affects the real economy. Indeed, concerns are that the pandemic could leave Eurozone lenders with an extra 1.4 trillion euros of bad loans, and this is well above the levels of the region's 2012 debt crisis. If that worst case scenario happens, analysts predict that house prices could plunge, triggered by a sudden tightening of the ultra-loose mortgage market.